Yes, we are here with Lars Christensen, an economist at Danske Bank. He is here in Iceland to discuss monetary policy with us on the meeting with, amongst others, the Finance Minister of Iceland. But we used the opportunity to get a short discussion about Russia with Lars. You are head analyst in emerging markets at Danske Bank. And before we begin, I'd like to compliment you on your socks.
Thank you, and likewise, very nice socks.
Thank you very much. Now Iceland has a strange and a nice relationship with Russia. And Iceland has had very strong relationships with the West, but also with the East. So the discussion about what's been going on in Russia has been quite prominent here in Iceland, and people are intrigued, at least, worried a little bit, maybe because of business, but we have been left out of it partly. But to begin with, I'd like to ask you what has actually happened in Russia. How hard have they actually been hit? How much has to do with what's been going on in Ukraine, oil, sanctions, and so forth?
I think maybe an interesting conclusion that we have drawn, given the events of 2014, is that when you talk to Western European policymakers, or you listen to comments from Russian politicians, it all centers around what's going on in Ukraine and the huge perceived importance of Western sanctions and Russian counter-sanctions on both the European economy and on the Russian economy. And to me, the sanctions issue and the geopolitical issue actually has had much smaller impact in the near-term macroeconomic impact than the general perception is. I think it has very significant long-term implications, but the actual development in the Russian ruble, for example, in the Russian stock market, in the Russian economy, is to a very large extent primarily a story about the sharp drop in oil prices. And I would say also the somewhat desperate monetary reaction of the Russian central bank to the sell-off, and that we especially saw in December, when that intensified. Russian central bank intervened very heavily in the currency markets to prop up the ruble and hiked interest rates very dramatically. That has a huge negative impact on the Russian economy. So I really think that the drop in oil price and the interaction between that development and monetary policy response really is what is hurting the Russian economy at the moment, and that is a significant negative blow.
Yeah. The next question has to be how much they can take of this, and that's something that's been debated quite a lot. And I'd like to quote two people. Putin, firstly, who has said that the worst case scenario is that this will take 2 years. Things will be fine in 2 years. The former finance minister, Mikhail Zadornov, he has commented on this, and he has commented on the stated reserves that they have, that they can actually use, gold reserves and currency reserves, which are stated to be 400 to 500 billion US dollars. That has been, they have gone through that quite quickly now, about 20%. But Zadornov says that this is grossly overestimated, because the amount of liquid cash that they could possibly use in the short term is probably only about half of this, maybe 200 billion, because much of it is committed in long-term infrastructure projects and so forth. So for how long can 200 billion last if they are trying to prop up the ruble, as well as trying to be a lender of last resort to support local businesses that cannot get adequate finances abroad?
Yeah, I think it's important to see that there wasn't really a problem as long as the Russian central bank just allowed the currency to weaken, to collapse, in fact. Obviously, that is a problem in terms of high inflation. Important. It's a problem for those institutions, banks, companies with foreign currency loans. But in the overall development of the economy, the weakening of the currency is very helpful in stabilizing demand. And for example, in terms of, for example, public finances, as long as the ruble was depreciating, it was compensating for the drop in oil prices. So the oil price measured in ruble has been relatively stable. And therefore, there wouldn't necessarily be a major public finance problem. But what of course happens now is that we get the worst of both camps, so to speak. We get we get the problem with foreign currency funding because the currency has been weakening, but we also get a problem because the Russian central bank has tightened monetary policy and then weakening financial system, sent interest rates up very, very sharply. We had, in late December, overnight rates, so very short-term funding for banks essentially, above 50%. And we are still way above 20% on money market rates, which effectively is a rather painful strangulation of the Russian financial system. And therefore we have also the view that the Russian central bank will have to make a choice whether they will continue this strangulation or they will allow a new depreciation. And in our view, there is only one viable option, that is to provide more liquidity to the banking system, but that would also necessitate a further weakening of the currency. And that will likely create problems for certain banks and institutions with foreign currency loans. And rightly, it is right that Russia's FX reserve have been drained very dramatically. The official is well below $400 billion now, which is significantly lower than if you look at the total amount of outstanding foreign currency loans. So obviously that can easily, that don't need to be a problem unless you have to pay now. Yeah. And that is basically the situation Russia faces because there is a sudden stop to the funding, there is no flows coming in, but there is a lot of flows going out.
So there are a lot of flows going out despite 70% interest rate. So that's not...
No, but I think, and one can see, you know, what really primarily has been the cause of this, regular Russian households taking money out of the banks. Regular companies are simply fear holding rubles. We, of course, in November and December had numerous stories about people just going down to the bank, trying to exchange their currency, their ruble deposit into foreign currency, but was told there is no more foreign currency available. So you take your money and you run to the closest IKEA and buy a new kitchen, or to the Porsche dealer and buy a Porsche if that is what you can afford. Those are, of course, anecdotal stories and some rather humorous in some ways, but it shows that the very, very seriousness of the collapse of confidence in the outlook for the ruble among regular Russians.
Do you have any views on how much it has to depreciate additionally to what's already happened?
I think one can assess it in different ways. I think a way to assess it, a very simple way, is what, under normal circumstances, what would be the needed oil price measured in ruble that we needed to have now to balance the budget in Russia this year. And if you use that rule of thumb, the ruble should be trading around 85 against the dollar at an oil price, Brent oil at 45, where we are more or less now. And so the ruble, just on that very simple measure, is probably 15% overvalued. One has to remember that the overvalue or the valuation for the ruble is a moving target. It moves up and down with the oil price. So that would be our view, that is at least where we need to go on the ruble. But then, of course, you need to add the credit risk, the political risk, the geopolitics, possible sanctions, and then you very far to approach something like 90 or even 100 on dollar ruble, and that is the kind of weakening we see over the coming year, under our assumption of stabilization, even slight upward move in global oil prices.
Do you foresee any currency restrictions on the ruble, more than has been? Well, they have withdrawal restrictions in some banks.
Yeah, effectively by also draining the money market is a technical way of introducing capital controls. Obviously, it's not a very long-term useful way, but it has worked in the same way. And I think that's why the ruble stabilized in the second half of December, was effectively by introducing that kind of quasi-capital controls, by taking out liquidity of the money market. But I do think that there is a very significant risk of capital and currency controls, and the reason for that is that the central bank has all year 2014 fought against it very openly, said we don't want capital controls, and I strongly believe that is the view of the central bank in general that it would be counterproductive. But there has also been increasing political pressure from certain members of the Russian Duma. Even advisors to Vladimir Putin has said capital restrictions would be the way forward. President Putin has said no way, but that could of course change. And I think that the actions of the central banks in December to some extent reflected that pressure. They tried to avoid capital controls, so they did something else rather desperate, tightening monetary policy very dramatically. And of course that has essentially triggered a banking crisis in Russia. So you could say that if they now have to move in a situation where they provide more liquidity to the money market, the ruble start to slide again, then the pressure to introduce capital controls will increase once again. So I do think there is a very significant risk of that.
With the oil price at the current levels for some time, how long can this really go on?
I think what maybe is a somewhat scary comparison, at least if you're Vladimir Putin, is the situation in the late 80s. In the late 80s, more exactly in 86, we had a very sharp drop in oil prices, to a very large extent driven by Saudi/OPEC-led global price war on oil, which to some extent is similar to what we certainly have seen over the past year, and the magnitude of the drop in oil prices was similar to that we've seen. It's even bigger. If it should have dropped as much, we should have gone to not to 45 but to 40. What happened then in 80, 86, 87, 89 was that we had a rebound. And if we're going to see a similar rebound, that rebound would be not to 100 but to 55, if we're just playing out the late 80s scenario. At that time the level was different from now, but just in magnitudes. At dollar price stable at, let's say, 55, oil price stable at $55, there will still be significant pressure for the ruble to depreciate. And we basically need to see oil prices go up, measured in rubles. So either oil prices have to go up or the ruble has to weaken to stimulate the Russian economy. So if we stabilize at 55, we need to see more ruble weakening. And of course, that if they don't like that, if that creates problems and they fight that, you will have to tighten monetary policy. And that is a challenge. And what we saw, of course, was that in the late 80s we rebounded, but we stayed at low levels, essentially until the first Gulf War in 91. And if we go, and of course we all know what happened in 89. The Soviet Union essentially fell apart. And we have seen it every time we see oil prices fall or stay low. The Russian public finances get into serious trouble. The tensions increases. We saw it, of course, also in 98, where after having the spike during the Gulf War, oil prices started to come down again, and then had a new crisis in 89. And one can say that one of Putin's successes is that he has only lived in a world of constantly rising oil prices. Yeah. So, and that has changed. And that, of course, means that that also shows the weaknesses, structural weaknesses in the Russian economy. As long as oil prices are steadily rising, or not even steadily, 20% a year, then everything looks very well. Once oil prices stagnate or even fall, a lot of the underlying structural weaknesses in the Russian economy becomes very apparent. And that's what we're seeing also to a large extent now.
Right at the beginning you said that there's a slight misunderstanding about what's weighing the heaviest on them at the moment. And a lot of the discussion has been very political about what is actually affecting them, why is this being done. There is quite a loud voice coming from, not only from Russian media and public, but from the Russian government, saying that this is some kind of a conspiracy against Vladimir Putin himself. That all of a sudden now they're defending their citizens in Russian-speaking people in Ukraine from genocide protected by the West and something like that, doing normal things, and all of a sudden there's an agreement to push down the oil prices that will, to of course affect them mostly as a very an economy that's very weak, very sensitive to oil prices. and then you implement these sanctions. Is there any truth to this being pointed at Putin himself, as the discussion seems to be?
Yeah.
There is the deputy prime minister. Putin didn't make it to Davos, but Igor Shuvalov, who was the deputy prime minister, he was there, and he said that Russians are willing to sacrifice their wealth to defend Vladimir Putin. That they are willing to eat less, they are willing to use less electricity in order to do so. That the sanctions are an attempt to get rid of Vladimir Putin.
There is no doubt about the conflict, and we can see that there's very significant deterioration in Russian-Western relationship, and that, of course, to a very large extent on both sides, centers about the person of Vladimir Putin. For example, I think most notably the relationship between Chancellor Merkel in Germany and Vladimir Putin has soured very, very dramatically. I do see that, and obviously, if we look at the sanctions, they have been directed. The sanctions against individuals have been very much focused on policymakers, business interests close to Vladimir Putin. So, you can understand the perception of what's going on. The question is then, of course, you will regularly hear in Russian debate and Russian media that the drop in oil prices has some way been engineered by the US government. Or the Saudis are doing what they're doing under pressure from the US. We can, of course, not know anything about this. I would, however, more think that this is an issue of the Saudis being dissatisfied with certain competitors that have been entering the markets. But again, the 80s and 86 is interesting parallel. Michael Reagan, Ronald Reagan's son, has claimed that Ronald Reagan was pushing the Saudis then to cut oil prices, or to increase production, so to cut oil prices. That has been denied by the Saudis, and I think it is in the conspiracy. It's more of a conspiracy theory what we're seeing now. That being said, it's notable when Russia annexed Crimea. A few days after that, the President Obama announced that the U.S. was opening its strategic oil inventories, meaning basically putting oil on the market. And there is no doubt that in the global oil market there has been a discussion whether to that extent. And there is no doubt that the Americans, to some extent, have seen the drop in oil price as doing the work those sanctions were not doing. That being said, I also think that Western policymakers, particularly in Europe, have been quite concerned that this crisis would escalate to the extent of destabilizing Russia. And I think that many policymakers are even more fearful of what Russia would be if it wasn't Vladimir Putin's Russia. So I'm not entirely sure that there is an interest in the West that Russia should be destabilized politically and economically. And it's hard to see how Russia reacts. That being said, you have also seen that at least in December it seems like the Russian government, Vladimir Putin, foreign minister had Lavrov was softening his stance on Ukraine and towards the West. That being said, the kind of military fighting we've seen in eastern Ukraine in recent days indicates that we are far from having a peaceful situation in eastern Ukraine, and that can escalate again. And while I do say that we have overestimated the importance of that in terms of the currency and the macroeconomic impact, that does not mean that will remain the case. No. Because if this would lead to a further escalation that also officially would involve these are regular Russian troops going into Ukraine, official invasion of Ukraine, then the sanction would be stepped up very dramatically, and then the macroeconomic implication of the change. And I would also say that from a longer-term growth perspective, this re-emergence of a Cold War scenario obviously is not helpful for the global economy. But we are very, very far away from the days of the 80s. I do think people tend to forget how bad things were. Well, when, for example, when Gorbachev and Reagan met here in Reykjavik 30 years ago, that it was a very, very different situation globally than it is now.
How strong are the fundamentals of the Russian economy now? We remember when Medvedev took over as president, the reset button was hit, pressed, as they said. He emphasized a lot of the diversification of the Russian economy, of the need to have more pillars than just oil and gas. How has that panned out, and how strong are the fundamentals? Are they so dependent on oil that it boils down to oil and nothing else, pretty much?
Well, in many ways, Russia is all about oil. It's 80% of exports, natural gases and oil. This is a very important thing. The entire business cycle is about the development in oil prices and the monetary reaction to that. So that's the two various lines. But if you look since the end of communism, look at the Russian economy. Obviously, there was a period in the early 90s of massive economic reforms, but also very chaotic. And then the period over the past 15 years, under the effective rule of Vladimir Putin, has been one of gradual reform in certain areas. Significant consolidation of public finances, for example. Also, some opening up of the Russian economy, getting rid of capital controls, which we tend to forget. We actually had capital controls in Russia until 2006, so it's not that long ago. So there has been that, but I also think that particularly the past 5 to 10 years, we have seen a period of increased economic centralization, renationalization, and over the past 2 years, starting before what happened in terms of Ukraine, we have seen Russia putting up more trade barriers. The international we have a global institution called Global Trade Alert, which is do an annual survey or assessment of protectionist measures in G20 area countries. Showed that already in 2013, Russia accounted for 1/3 of all protectionist measures in the G20 areas. So already before what we have seen a significant move towards more protectionist measures in Russia. And I do think that the overall picture is that Putin's economic policy is one of greater government control over the economy. And that from a fundamental growth perspective is negative. And then of course we have one major challenge that Russia faces no matter what, and that's the negative demographics. The Russian labor force is shrinking, and particularly the very low average living age of Russian men is very concerning. So the underlying trend growth in the Russian economy is fairly small, and at the moment our assessment is that it might be as low as 2-3%. So even without any shocks and any crisis, the underlying trend growth in the Russian economy is very negative. And of course, what we would have liked to see had been measures to do that. Russia has, for example, over the past 15 years, or maybe forever, completely failed to invest in its oil industry. Because it has basically been very unwilling to let in foreign investors, and therefore we have significant underinvestment, and therefore Russia could produce much more oil had it had that investment. So that's it. So even in the oil industry, we have a structural problem, and so I initially when this thing started in 2014, our view was that the real concern was not the negative shock now, but what the implications was in terms of business climate and what that would impact foreign investment into Russia over the longer term. So we have been more concerned about what happens in 5 years than what would happen in 5 months. But what, of course, as the crisis have escalated, it has been impossible to focus on 5 year ahead, because the financial markets are telling us that in December we saw credit default swaps spike. And essentially, and it's still the case, is that if you look at credit default swaps, the market is saying to us there's a more than 30% likelihood of a Russian default, government default within the next 5 years. I think that is too aggressively priced by the market. I think the risk of a Russian default is lower than that. But it just illustrates how bad the crisis turns. So even though we can talk about long-term structural problems, there is a real risk of things blowing up in the short term.
I think we'll leave it at that. Slightly negative note, but it illustrates the importance of focusing on what's happening these days in Russia. And I'd like to thank you, Lars Christensen at Danske Bank.
My pleasure.
For joining us at VIB. Thank you for watching.